Hello everyone, my name is Vikas Shukla, and in today's video I will discuss the topic of the portfolio diversification with a special reference to the COVID-19, because COVID-19 situation has brought to light some of the theories that we can better understand not only this time but also for the future. To give you a context of the COVID-19 situation in the stock market, we know that there are two types of stocks. One that were positively affected by the coronavirus. The second they were very negatively affected by the coronavirus. And already know this example. I'm just bringing it to the light. For example, all the airlines, they are very negatively affected. Of course, for the reason that the government supported them, they could have been bankrupt. Then we have cruises that were negatively affected. The oil, a commodity or the stocks related to the oil, they were very negatively affected. The oil prices were down, so commodity as well as the oil stocks were down. But then there were a class of the stocks that were not affected or positively affected. For example, the Apple stock, the IT related stocks, they were very negatively affected. They were negatively affected, and then there were some stocks that were positively affected. For example, e-commerce, Amazon at least temporarily increased its sale. There were cloud related companies that increased its sale. There were there were increase in the demand of the cloud related services because many people had to work from home. Many offices had to let people work from the home, and that led to the demand in the additional computers, laptop, desktop, and those demands increase led to the increase in the sale of those things. So the cloud related services that saw an increase in the demand, the computer related hardware, the server, cloud related servers, they saw an increase in demand. So what we saw is actually three different classes that were affected by the coronavirus, and that brings us to the topic of the portfolio diversification. And before I go into, and I have this here, some of the things that we'll discuss mathematically, I wanted to relate you to some of the experiences that I heard on the internet from the people who had, for example, there was a person who invested all his stock, all his lifelong saving into one stock called Luckin Coffee. It's a Chinese coffee stock that was doing very well, something like $42 or $50 or something. It's not related to coronavirus, but it suddenly went down all the way down to like $2 or $3 because there was some scam noticed into it, and then the company just busted, and he lost almost all of his lifelong savings because of those happenings. So what you could do to avoid this situation, and I know that I could be keep your hands away. I could be doing the same mistakes. For example, I could be investing in the coronavirus, and there is no way I can avoid the fact that I will know beforehand that the coronavirus could the Luckin Coffee could go bust in a day. So what I could do is I could diversify my portfolio. So the person in question who lost all of his saving, for example, could have diversified his portfolio in three different stocks, and then that could have reduced his stock busting into three different. So, the coronavirus, so the Luckin Coffee mistake could be done by me as well. The only thing is that what I could do is that I could reduce its chances by diversifying into different portfolios. So that's the background of these things I was going to tell. Another thing is that Warren Buffett, for example, invested into airlines. There was nothing wrong with it, but then he invested into his stocks and then into different airlines to a big amount. So coming back to some theoretical discussion that I'm going to prepare for you for, it is there's a person called Harry Markowitz. He was a Nobel Prize winner for his theory called a modern portfolio theory, and I will discuss about it to theoretically show you how the equations favor for 3 stocks at the minimum. I mean, you could do more than 3 different class of assets, but you should do at least 3, and then I will tell you why. Then I chose the number 3. Before I do that, I wanted to tell a few things about the classes of the assets. So the asset classes, one asset class we know is called the stock, that we all know and talk about, but that asset class is related or not related to the asset class. So what is that correlation, and we need to understand very clearly about it. The asset class could be, for example, I'll write it here, there could be cash, that could be your bond, it could be your CD, the certificate deposit that gives you a fixed interest, something like 2%, 1.5%, and then it could be gold, this is another asset class. Then we have real estate, and then we have commodity, and so on and so forth. I can keep on writing, but the key point here is that the one asset class is very different from the other asset class. So if one thing goes down, other may or may not go down. They are unrelated, and that we define with a mathematical term called rho is the function we will use, and then this rho varies from 1 to -1. So rho is 0 means those two assets class are completely unrelated statistically. Rho is equal to 1 means those two classes are completely related to each other. Rho is equal to -1 means the asset class are inverse related. So if one increases, the other decreases, and in a completely related fashion, in the sense that they are negatively affected. So the asset class we could define in this thing, and then we will come to that why this term is important. For example, in case of the airlines, let's say we have American Airlines and we have Southwest Airlines. If you invest into the airline stocks or know about it, for example, AL is the American Airlines and LUV is the stock for the Southwest Airline, and they are kind of have a rho equal to 1, completely related, more or less. So with that said, let's go and look at this equation, and Harry Markovich, he talks about two terms. One is called a variance, and the other term is the rate of return. And we need to understand these two terms before we move on to discuss more about it. Let me wipe that off here. And so the variance means if a stock is very volatile, we say that this variance is 100% or 1. If the stock has zero variance, we call it that the stock it's fixed. For example, the cash, the money you have, has a zero variance. It could also be certificate of deposit that has a zero variance. Something like a commodity will have a higher variance, and so on and so forth. And then each asset class will have a rate of return. For example, if I move it like I put it at the certificate of deposit will, for example, come somewhere here. It will have 1% or so rate of return, and then stock could be somewhere here. Commodity, that will have maybe 10% rate of return, but a reasonable amount of variance. And then within the stock there could be different types of stock that will have different variance and different rate of returns. For example, highly volatile stocks could be somewhere here, where it's like a new startup companies that may have a higher rate of return but potentially high variance. It could go bust. In the same way, we can have commodity somewhere here as well, that gives a higher rate of return, but they are more volatile. So on and so forth, we can define everything in those different classes of return. Now, if you, instead of one class of asset, if you have two classes of assets, the effective rate of return, I call it RE, has a formula W1, which is the weight of the first stock, which is the percentage of your diversification, multiplied of R1 plus W2 R2. What does that mean? Let's say I have two asset class and we diversify into two different portfolios. For example, I take American Airlines and Southwest Airlines. These two just stocks. Now I'm not going into stocks plus CD or stock plus DC, just two stocks, and I will diversify. With this kind of things, I use 50% of A is just 50% in AAL and 50% in Southwest Airlines as LUV. That's the sticker symbol for it. So my effective rate of return, that is, I am keeping W1 equal to W2 is equal to half. That will be half because I am investing half of them, and the rate of return of both, and let's say, are equal, and I call it R1. So my net rate of return will be W1 R1 plus W2 R2, or this rate will become W1 2 W1 into R1, because W1 is same as W2 and R1 is same as R2, and this, because W1 is half, so this rate of return is same. So we have the same rate of return as, because we did not do any diversification, and then this is what the formula for those two. The main point is the diversification. This is variance. What happens to variance? The variance for these two stocks, you see, effective is equal to, let's say both of them have the same variance, because these two are completely related stocks, American Airlines and Southwest Airlines. So we will have rho is equal to 0, so this term goes down to 0, and then this two terms, some of these two terms we will have, and then sigma 1 is equal to sigma 2, and let us call it sigma 1, denoted by sigma 1. So we will have W1 square to sigma 1 square plus W1 square into sigma 1 square, and this term, whole term, becomes 0, and you have effective variance is equal to 2 times of W1 square sigma 1 square, and sorry, we have rho here is equal to 0, third term is not 0, because rho is 1, so these two stocks are completely, totally correlated. 0 means they are not correlated, but in case of American Airlines and Southwest Airlines, this rho is 1, so we will have 2 into rho is 1, W1 into W2 is W1 square multiplied by sigma 1 square. So this 2 W1 sigma 1 square plus 2 W1 sigma W1 square sigma 1 square, this becomes 4 W1 square sigma 1 square, and you know that W1 is 1 half, so it becomes 1/4 multiplied by sigma 1 square. The effective variance is equal to the original variance. What does that mean? That this diversification has no meaning. If you are putting all your eggs in the similar kind of basket, you have not reduced your risk. This means you have not reduced your risk as far as this thing is concerned. So what I am going to do is, I will make the things change a little bit to show that by diversifying the things a little bit, how you could be positively affected. So instead of diversifying into American Airlines, I could use some asset class. Could be totally different from American Airlines. It could be something that is still giving that kind of return that American Airlines would give. For simplification, let's keep it maybe a bond. And let's say for simplification, our rate of returns as R1 and R2 are still same. Bond will obviously be giving a little lower return, so our effective return may go down, but I'm doing it for simplification, but you will get that idea. And then my effective rate of return will still be same, because I have simplified it. I have 50% here, 50% here, and R1 and R2 are same, so I still get the R1 rate of return. In reality, our effective of return may be less than, let's say, if I keep it R1 and I say this one is R2, where R2 is less than R1, then our effective rate of return will be less than R1, but of course greater than this R2, which is the bond's rate of return. But for the simplicity here, what my interest is to see how this is going to affect my variance, how the chances of stock going bust. So what I do is, in my case, because the bond is completely unrelated to the American Airlines, whether the American Airlines go bust or down has nothing to do with the bond rate. So in my case, the rho here is 0. And what does that mean? That means my sigma E is equal to W1 square sigma 1 square plus W2 square and sigma 2 square. And let me keep because rho is equal to 0, and let's say I have kept this bond has the sigma is very less for this bond. So where does it land me to? By sigma E in this case sigma 2 is 0, so this becomes W1 square sigma 1 square, right? And then my variance is now sigma effective square is equal to square root of W1 multiplied by sigma 1 square. And now what does that mean? In W1 times of sigma 1. And W1 is, we know, let us say W1 is equal to 1/2. We divide it half and half. What does that mean? My effective variance has reduced by 1/2. If I had a variance of, let's say, 60%, then my new effective variance is 1/2 of them. I have reduced my chances of going bust by half, or the amount of it by half. So before I move on to this, I want to give you now in case of bond I selected this W sigma 2 was 0, but instead of this, let's say I have any XYZ any stock or something which has some variance which is not 0 but it's same as American Airlines. So why am I assuming sigma 1 is equal to sigma 2? And then let's divide this stock in two different parts. So what do I get? And they are completely unrelated. So I cannot select, for example, Southwest Airlines here. So what I do is I get an effective variance sigma E as W1 square sigma 1 square plus W1 square sigma 1 square, or 2 sigma W1 square sigma 1 square. And in my case, the effective sigma, this thing is going to be equal to square root 2 times of W1 is 1/4, and this sigma 1 is equal to sigma 1 square, and this becomes half. So sigma effective variance is going to be sigma 1 divided by square root of 2. So we have reduced again our variance by a factor of 1 by square root of 2 by diversifying my portfolio. Both this portfolio, they have the same rate of return, they have the same kind of variance, but the only difference is they are unrelated. And by making them this row, the unrelated, by diversifying my assets into two completely unrelated things, I reduced my chances of going bust by a factor of 1 by square root 2 or 0.707. I believe you can mentally imagine like this. I invest one thing in an airline stock, and I invested other things in gold, for example. And we know that gold also is rising more recently. In Covid-19, it keeps rising. So while the American Airlines goes down, gold independently goes up and down, and that's why in theory, I have reduced my chances of correlated going all my investment going bust in the same time. It could happen that the gold also could keep down, but the chances are less. So let's move on to give you a more generalized kind of thing. Let's say what happens if I invest into 3 such stocks. In a similar way, I could show that the 3 assets, the formula gets a little wider but bigger. W1 Q sigma 1, W1 square sigma 1 square, W2 square sigma 2 square plus W3 square sigma 3 square plus 2 times of this factor plus this factor plus this factor. I will not go into the whole thing, but if rho is equal to 0, if the 3 assets are completely unrelated to each other, then this sigma effective square will become is equal to W1 square sigma 1 square plus W2 square sigma 2 square plus W3 square sigma 3 square. And if I distribute them equal, then we have W1 equal to W2 equal to W3, and then we have the simple formula 3W1 square q sigma 1 square. And then I can say W1 is equal to 1/3. I equally divide into 3 parts. Then I have sigma E square is equal to 3 into 1/9 multiplied by sigma 1 square, or sigma E square is equal to sigma 1 divided by 3. So sigma 1 square by square root of 3, and if you do a calculation of this comes around 0.57. So if I plot my graph like this, where n is the number of the different diversified equally divided, that's for simplification. You could vary W1, W2 by allocating more assets to one and then to the other, and then we could tweak with the sigma and R return ratio. This is a whole bunch of gamut, and that's what this Harry Markowitz algorithm or things are like that. You could optimize this sigma and R, but I won't go into that theory. I want to break it down to simplify, to relate it to your real world scenarios. So what I did was I said instead I start with n is equal to 1. Let's write here, and let's say what is the kind of variance you see. Let's say I call it sigma 1, which could be like 20, 30 or 50, maybe even higher, 90% or something. With that sigma 1, if I diversify it to 2 different stocks, my variance reduces from sigma 1 to 0.707. So I reduced my chances of going all my things going bust by 30%. And if I go n is equal to 3, that number reduces to something like 0.57 or something like that. And if I do n is equal to 4, the number further reduces to close to 0.5. And if I go to n is equal to 5, I will get something like 0.47 or so. So what you see that I get most of the benefit by diversifying my unrelated class of assets or unrelated class of stock from sigma is equal to from n is equal to 1 to n is equal to 3. That's why I come up with the golden number of n is equal to 3. So you should typically diversify your portfolio to at least 3 different unrelated stocks or assets. If you could do assets, that's even good. Maybe you invest into the stock market, into gold or something like that. But if you can get into fourth one on a limited basis, that could be even better. But my suggestion would be to diversify your portfolio into at least 3 equally divided these things. So with that said, I would encourage you to, if you are mathematically inclined, I would encourage you to read about Harry Markowitz, his algorithm and its implementation. But at the minimal, I brought this point just to bring out the point that mathematically diversification is only going to help you. It's not going to not help you in any way. I can understand there's one negative effect of diversification is you need to spend more time into finding out what that different asset class would be. You need to find those. It's hard to find a good asset that you could invest to even getting and that investment gets you a better return. You want to maximize. That is the problem. You have a very hard time finding an asset class that you believe to get you a better return, and then you find another one is even difficult, the third one and fourth one. But you should keep looking at, thinking about which asset class has the higher rate of return, even if it has the same asset rate of return as the one you already have, and it has the same variance, same kind of risk. Even then you should diversify it from n is equal to 1 to at least n equal to 2, and better n equal to 3. But then if it's easy for you to go to the fourth, go into the fourth. If it's hard for you to go into the fourth, you diversify into 3. So that's what I'm going to say. That's the different asset class. Means that one stock, you diversify your investment into the stock, into the bond, into real estate, into gold, and so on and so forth. But within the stock itself, you should diversify into the stocks that are unrelated to each other. And what that means is that when the whole stock market goes down, the complete stock market goes down, you should select a stock that is relatively unaffected by the complete stock market meltdown. And this will mean that you, within the stock market itself, you will allocate at least some part of it into kind of startup type of the stock. So the startup type of stocks are a class of stocks that are more volatile, but because their chances of going bust with the stock market going down is unrelated, because they are dependent upon the success of their startup. So if a stock is making only like $5 million in first year, but the chances of making a much bigger revenue in coming 2 to 3 years is much higher, then that will happen independent of the whole market stock goes up or down. So that's where you could invest some part of the portfolio, like 5% or 10% into especially. And then another thing is, when the market is relatively high, the whole market is, for example, currently on August 7th, 2020, stock market is very high. In that scenario, if you stay invested, then the whole market goes down, there's some good chance of that could happen. I'm not a astrologer to predict that, and not even a stock market predictor, but there is a good chance it's an near all-time high. Gold could go. You should prepare for the scenario where the stock market could come down by, let's say, 20%. How you are diversifying yourself against that scenario. And there could be one way to do is to take something money out of the stock and invest into what? Maybe real estate, maybe somewhere else, maybe something else. I don't know, I'm not an expert into that area, but at the minimum, you could diversify some of the stock into the class of the stock that are already down. For example, airlines are down at the moment. It could be risky, but you could invest into that. Or you could invest into startup type of companies, the companies which are like still coming up. For example, Nikola or something like that, very small portion, so that the whole market stock busts down, that startup company starts rising, it will start rising irrespective of the stock further goes up or down. So I hope you need to think and you need to plan your own strategy about this stock diversification, and I hope that my video throws some light of it. If you like this, just let me know. If you have more questions, just put it into the comment section and I will like to answer those as well. Thanks for taking a look.